All right, let's talk about a big name in Canadian real estate, SmartCentres REIT. If you're an income investor, you've probably seen that high dividend yield and thought, wow, that looks tempting. But is it actually a smart investment? Is that dividend safe, or is it maybe a bit of a red flag? Well, we're going to dig into the numbers and figure out if this is a good spot for your money.
So, here's our game plan. First, we'll get to know the company. Then we'll dive deep into the financials, and I mean really get under the hood. After that, we'll weigh the pros and cons, look at some possible future scenarios, and then, the big one, we'll figure out what a fair price to pay actually is. And of course, we'll wrap it all up with a final verdict.
Okay, so first things first. Let's meet SmartCentres REIT and get a feel for just how big this operation is. To give you a sense of scale, just look at this number. We're talking about almost $1 billion in Canadian revenue every single year. So right off the bat, you know this isn't some small-time player. This is a major force in the Canadian property market. And at its heart, the business is really straightforward. They own a huge portfolio of retail properties, and they collect rent. Simple, right? But what's really impressive is that 58.5% operating margin. That tells you they are incredibly efficient at turning those rent checks into actual profit. It's not just about size, it's about being good at what you do.
All right, we've got the basics. Now for the fun part. Let's pop the hood and take a look at the financials. This is where we see if the engine is really running as smoothly as it looks on the outside.
Okay, these are like the vital signs for a REIT. First thing that jumps out, the share price is actually lower than its net asset value, or NAV. Think of NAV as what the company's properties would be worth if they sold everything off today. So a discount like this suggests the market is a little bit cautious. Then you've got these cash flow multiples, FFO and AFFO. Now, FFO is standard, but the one we really need to pay attention to is AFFO.
So what on earth is AFFO? You can pretty much forget about normal net income when you're looking at REITs. AFFO, or Adjusted Funds from Operations, is the number that really matters. It's the truest measure of the actual cold, hard cash the company has left over after paying all the bills to maintain its properties. Simply put, this is the money that's available to pay out to investors like you and me. And this slide right here is exactly why AFFO is so crucial. Look at this. The company is generating about $1.93 in cash per unit, but it's paying out $1.85 in dividends. I mean, you don't have to be a math whiz to see that as an incredibly tight margin. There is very, very little wiggle room there. In fact, if you do the math, it brings us to this number, 96%. That's the AFFO payout ratio. It means 96 cents of every available dollar of cash is going right back out the door as a dividend.
And yeah, that is definitely a potential red flag. A 96% payout ratio means that dividend is basically walking a tightrope. It's covered, for now, but it leaves almost no cash for anything unexpected, like a major tenant leaving or interest rates going up. It basically relies on everything continuing to go perfectly.
So, with that risk in mind, let's put it all into the bigger picture. It's time to weigh the strengths against the weaknesses and see how this all balances out.
I love this table because it really quantifies the whole story. Look at the top line. Strong cash flow gets the highest weight. It's the most important factor, and it gets a great score of 8. But then look at the next two most important factors, that high payout ratio we just talked about, and its debt, or leverage. They get much lower scores. So this lays out the trade-off perfectly. You're getting fantastic, stable cash flow, but you have to accept the risks that come with that high dividend payout and a good amount of debt.
Okay, knowing that balance of risk and reward, let's look to the future. Where could the stock price actually go from here? Let's explore a few different possibilities. The analysis basically lays out 3 paths. You've got your bear case, things go south, maybe retail demand weakens, and the price could drop into the low 20s. Then there's the bull case. Their new developments really pay off, and the stock could head up towards 40. But the most likely scenario, the base case, is just business as usual. And in that case, the analysis sees the price pretty much staying right where it is today.
So all of this brings us to the most important question for any investor, right? What should I actually pay for this thing? Let's translate all this analysis into some real, concrete numbers.
And I love this question because here's the thing. There isn't one single right price for everybody. It completely depends on what kind of return you need from your investments.
This table makes it super easy. Just find the annual return you're aiming for, and it tells you the target price you should be looking to buy at. So let's say a 7% annual return sounds good to you. Well, then the analysis suggests a buy price around $29. But if you're a bit more ambitious and you want a 9% return, you'll need to be patient and wait for the price to drop to around $25.
Now, let's stick with that 9% return goal for a second. This is really interesting. It shows how your timeline changes the price. If you're only planning to hold for 5 years, you could pay up to $27. But for any hold longer than 10 years, that ideal buy price settles right in at $25. The message here is crystal clear. If you're a long-term investor, being patient and waiting for the right entry point is absolutely critical.
Okay, let's bring it all home. It's time to put all the pieces together and land on a final verdict based on this analysis.
The final scores are pretty telling. The risk comes in at 5.8 out of 10, so moderate, right down the middle. The opportunity score is a little higher, at 6.5. What this tells me is that you're looking at a pretty balanced situation. You aren't swinging for the fences here hoping for a home run. This is a play for steady income with some very clear and manageable risks.
So, if we boil it all down, here's the core investment thesis. SmartCentres is a classic, stable, income-focused REIT. You get that really attractive 6.57% dividend yield. But the trade-off is you're not going to get much growth. And you have to be comfortable with that moderate risk profile we've been talking about, driven by its debt and, of course, that very high payout ratio.
And that leads us to the final recommendation from the source analysis. At its current price, the verdict is a hold. But for those of you focused on income, it becomes an attractive buy if and when the price dips below that key $25 mark.
And that's our deep dive on SmartCentres REIT. I really hope this helped you get a clear picture of the company. Now, I want to hear from you. What company should we break down next? Drop a comment below and let me know. Thanks for tuning in.